I think they are taking preemptive measures to go against Trump in case the tariffs become quite hawkish. So that's basically the external forces that could come next year. But I think in terms of internal forces, what's becoming a bit worrying is in terms of like consumer confidence, that is quite low. So they need, and they realize that they are now at a turning point. They definitely need to boost it. Property prices are stabilizing, but it's not rising enough. So I think the quick way they can basically boost consumer confidence at this point is through the equity market.
We don't exactly have too much selling taking place though today, and if in fact you look at the Shanghai Composite, we had that huge bounce in September. We came off a little bit, we've went back up, we came off a little bit, gone back up again, and you can see even the market today 6/10 plus. It seems as though some in the market are backing Chinese authorities to get this right. How possible is it to stimulate domestic demand, though, in a context where, there's not much social security still? That's a big measure. We've only had tiny measures to stimulate consumption, and there's still the overarching property market issues for many people who've been invested in property trying to weather.
So I think we've seen a shift yesterday, as in the property side as well as the investment side have been priorities so far. I think next year there's going to be much more focus on consumption, given like the external forces that I mentioned, but also the fact that if you look at like domestic stocks and consumer-driven stocks, they have been on a downslide for the past 2-3 years. So I think there's a sense of urgency to basically boost consumer confidence. I'm quite confident they're going to be able to do that. And one way to do that, as I said, is basically through the equity market. So if you look on a wealth effect, Chinese basically have 70% of their wealth in the property prices. The rest, you can assume that 10 or 15% is on equity markets. And actually, if you look at the opening of A-shares brokerage accounts, it hit a 2015 high just before the announcement. So I think there's everything in there to basically point towards like policymakers trying to boost Chinese wealth effect through the equity market.
How much of that touches European equities? Because if you look at the French market, we know that there's been a lot of pressure on some of the luxury names. They have spiked off the lows that we saw from November and certainly lifted into December. But should there be more to come if you think consumption is generally going to work? Will it help luxury stocks?
I'm definitely more positive on European equities. I think in terms of the divergence between US and rest of world, it's really at super stretch levels at this point. In terms of European equities, I think markets have been a bit wrong trying to look at tariffs as the biggest negative factor on European equities. I think what matters much more for European equities, and especially some sectors such as luxury, materials, as well as energy, it's much more China. So if you look at the earnings growth downgrade we got since the start of the year, it's been all China driven. So tariffs at some point, it's more sentiment driven. If you look at in terms of revenues exposure to the US, MSCI Europe, around 25% of the revenues are generated in the US. But if you look actually at how much are going to be really impacted by tariffs, it's 1/5 of it. China is a much more important driver to consider if you want to start looking to European equities.